Okay, welcome to episode number 12 of this series. The goal in the series is to give you important concepts that you need to know about real estate tax topics in under 10 minutes. It's a series. You may want to reference some of the other episodes as you view this one. Number 12 is all about capital gains and depreciation recapture. These typically kick in when you sell your rental property. As always, we're going to discuss the benefits, the gotchas, and the execution related to this real estate tax topic. Without further ado, Michael, can you give us some insight into the benefits applicable to real estate sales?
Of course, Bernard. It sounds a little bit strange to talk about benefits of something that causes you to pay taxes. In other episodes, we discussed things that you can write off that reduce your income. But now we're talking about situation when you sell your property. When you sell your property, you generate income. More income means more taxes. How is it potentially a benefit? Okay, so when we say benefit, this is what we mean. First is the rates. So it's a relative benefit. That means if, let's say you did a flip, you sold the property that you flipped and bought that property for 100, put 50,000 into rehabbing and now sold for 200. And you made 50 in the process. That 50 is taxed at your ordinary rate, which could be, depending on your overall income, different, but let's say 24%, which is a fairly typical rate for middle income investors. So you have 24% regular rate at the IRS level, at the federal level. And then you also have self-employment tax of roughly 15%. So here suddenly 24 plus 15. That's, let me get my calculator, check, Bernard, like I think it's somewhere around 40% combined. So about 40% of what you made goes to Uncle Sam, and only slightly more than half is left for you, 60%. Not a very good split. But if the same numbers were applied to your rental property, you bought it for 100, put 50 into repairing that property, held it for a while, rented it, and now selling for 200. Same numbers, you made 50. So the rate on that 50 will not be 40%, but will probably be more like 15%, 15, which is way better than 40%. So the first benefit that we're talking about is the rates on capital gains are less than rates on other types of income, such as income from being wholesaler, realtor, flipper, all these other investments, types of real estate investments that we are addressing in our other episodes. And even better part is, unlike most of the income that you generate from other types of real estate investments, capital gains you can plan against. You can defer them, meaning is put them into the future. You can minimize them, sometimes eliminate completely. And we are going to discuss various planning techniques in future episodes of our series. Let's move to the gotchas, Bernard.
Okay, let's do it. As Michael mentioned, the taxable rate and the taxable gain are key components here. So we spoke a bit about rate, which actually can vary, but let's talk about the actual gain calculation. So before you actually apply a tax rate, we have to determine what is the amount of taxable income, or in this context, we call it taxable gain, to which the tax rate is applied. Now, the gain calculation is often not intuitive. We find many investors
often.
Okay,
are you implying
never
the
intuitive
situation when it is?
Now, many investors, and I'm going to throw out that this is sometimes can be work in your favor, and sometimes it works against the investors. What we find investors often taking their perspective is they look at their closing statement and they're like, okay, or they calculate back of the napkin, if I sell this property, I sell it for $1 million, I'm going to pay off the bank, I'm going to pay closing costs, I'm going to pay the realtor, and I'm going to be left with $200,000. Oh, and that's my taxable gain here. And now let's apply 15%, whatever the rate is, to $200,000, and that'll be my tax bill. If only it were that simple. The reality is that, and the big one is paying off the bank. So let's just focus on that to simplify it. Paying off the bank, paying your lender on the property does not reduce your gain. So the calculation of your gain is not reduced by the amount you pay the bank. The second big one is that your gain is going to include giving back, so to speak, the depreciation that you claimed on the property. So if you own the property for, say, 12 years, at this point, you've claimed about a third of the depreciation that you were eligible to claim. Cost segregation aside, there was an episode about that. You're going to have to give that back. Whatever depreciation you claimed, Uncle Sam says that has to, so to speak, be reversed on the way out, assuming you sold it, for a gain. Obviously, if you sold for a loss, that doesn't apply. But to the extent you're selling it for a gain, you also have to return the depreciation that was claimed over the years. I would want to put this back on Michael's plate because you're a master at simplifying these topics and explaining them in a way that's easy to understand.
Yeah, I wish I could be up to the task of simplifying that. Simplifying depreciation, recapture, and capital gain calculation is next to impossible. But I made a joke earlier about that never being intuitive. It is intuitive in one situation only. One situation will be this. Let's say that what you owned was undeveloped land that you never touched, and you paid cash for that. Then it would be simple. You bought that land for 200, you are selling it for 300, your gain is 100, but then still the rate that you pay on that 100 will not be 15% that you heard about. Why? Because the 15% changes depending on your overall income situation. It could be as low as 0, it could be way higher than 15, depending on multiple factors. So unfortunately, even if we can simplify gain calculation and figure it out, the rate will not be possible to estimate. But what Bernard was talking about, depreciation recapture, makes it completely crazy, because what we have is essentially two taxes. Let's take an example again. You bought property for $500,000 years ago, and since you held it for a long period of time, it's now worth twice as much, $1 million. But during that period of time, you took 200 worth of depreciation. Okay, so remember again, bought it for 500, selling for $1 million. First component, you have $500,000 gain. That is true capital gain from appreciation in value. That is taxed at one of the rates. Which rate again? Oh my God, 0 to 37%. We cannot give you a number, but that's not all. Then you have the 200.
Well, I guess on that portion, we know we're not getting up to 37 over there. We know Correct. You're going to be capped at 20 on that portion of it.
Yes, but still there are complexities, as you know. Okay, it's also not 0 at that level. Correct.
Yes.
But I mean, we cannot give you a specific rate to use for your napkin. And then we have 200 of depreciation recapture, which means is you took 200 worth of depreciation benefits before. It was great, but it was great for the time period. Now you have to reverse that, give back all of these benefits to Uncle Sam. So now Uncle Sam will tax you on the 200 depreciation you have taken over the previous several years. Oh my God, why? We're not talking why, we're not talking logic, we're talking about complexity of calculation inside, because in addition to capital gain tax on the $500,000 growth in value of the property. On top of that, you will have to pay depreciation recapture tax on the 200. What is the rate? Some people say 25%. Well, really, it's not the rate, it's the ceiling. It does not go above 25, but it can go below. Enough complexity for everybody, I hope. The point is, and if you think we stop complexity, no, complexity only starts here. This is why when you sell a property, it triggers domino effect. Some other pieces come into motion. For example, remember in one of the previous episodes we talked about how passive activity losses. Maybe those losses were locked over all of these years because you could not qualify for real estate professional status. These were not short-term rentals, they were locked. Now you sold the property, but when you sold the property, suddenly those losses become unlocked. Is it only from this property? Gets complicated if you have other properties. What if you have syndication? What if you have all of this? See that whole Jenga construction. Once you pull one of those pieces, can completely create unexpected effects, and suddenly that napkin becomes totally useless. Which way? That's the interesting story. The interesting conclusion from that is your calculation can be wrong either way. Sometimes your estimate of that, let's take 15% of what I believe the gain is. Like we were trying to illustrate with Bernard is, you are probably wrong in the number of what your gain is, and you are probably wrong in the number of what your rate is. But even if you get those two close enough, all of these other pieces can create a result to be way higher or way lower. So a lot of people immediately jump into, oh, we need to do 1031 exchange in order to minimize our capital gain impact. Maybe we will have a special episode about 1031 exchange next. We'll talk about that. But before you do that, what you need to know, what is the actual impact? Your impact could be way less than you believe it is because of interplay of all of these different factors, which brings us to that conclusion of our episode execution. Bernard.
Yes, and the execution here, we wish we could condense it to some 2 bullet points of what exactly you should do. The reality is that as you've seen, there are 2 things that have to be calculated, 2 areas of calculation, and both can get very complex. One of those is the actual taxable impact of the transaction itself, viewed in isolation. The second is how that sale interacts with all the other components of your tax profile. And none of those can be distilled to a back of the napkin calculation. So before proceeding with a sale of your property, it is important, it is absolutely essential to get an accurate calculation of both the direct impact of the sale and its interaction with the rest of your tax return, because that will put you in a position to make smart tax planning moves, because there are a host of tax planning tools available to mitigate, eliminate, or defer the taxes on the sale of highly appreciated real estate. But in order to do smart planning, you need an accurate assessment of what the actual impact of that sale will be.
Okay. The good news to close that episode will be that this episode that I believe, Bernard, you will agree, probably was the least useful of all our episodes. We did not give any information other than we told people is you cannot estimate anything. You know, whatever you estimate will be wrong. Unfortunately, that's the truth. But is one of the least useful episodes is going to be followed by our next one, which is one of the most useful about 1031 exchanges, which is an extremely powerful strategy to mitigate capital gain tax on selling a property, assuming it is significant enough where that strategy is helpful. See you on the next episode. Thank you, Bernard. Thank you, everybody who is listening.
Thank you, Michael. Thank you all. See you in the next episode.